The notorious dot-com bubble, also known as the tech boom or internet bubble, was a period from about 1995 to about 2001 during which internet-related tech companies attracted a massive amount of attention from a venture capitalist and traditional investors alike. This influx of money, combined with the exploding popularity of the internet in general, caused the web sector to expand rapidly in terms of valuation over the course of a few years, despite many companies lacking concrete paths of profitability. Low interest rates in the late 1990s made debt financing easier for young, ambitious tech companies to acquire, further fueling the internet industry's unchecked growth. Eventually, around late 2000, these streams of easy money dried up and the industry imploded, causing many tech companies to go under and ushering in a new bear market that would last for around 2 years and affect the entire stock market, not just the technology sector. Now, how did the dot com bubble form? In the early 90s, the advent of web browsers made the internet much more accessible for the average consumer. Once rare, computers began to appear in more and more households in the US, eventually becoming somewhat of a necessity. As the popularity of computers and internet grew, many new web companies emerged to carve out their slice of the rapidly expanding information technology and online commerce industries. In the late 90s, low interest rates made speculative equity investments more attractive than bonds, and at the same time, innovative internet companies grew in popularity among retail investors, professional traders, venture capitalists, and alike. When the Taxpayer Relief Act of 1997 passed, the top capital gain tax rate was lowered, providing yet another incentive for equity speculators to pour money into the fledgling internet industry. Investment banks earned massively by facilitating IPOs for one tech company after another, and stray eyed investors threw fundamentals like price to earning ratio out of the window and pumped money into young dot com companies for fear of missing out on the digital gold rush that was sweeping Wall Street. This influx of money acted like a billows, inflating the untested internet technology industry over an overvalued bubble ripe with surface tension and ready to burst. When and why did the dot com bubble burst? It's always difficult to identify a single catalyst that causes the bursting of an asset bubble. But in the case of the internet bubble, two factors seem to have played at least some part in the industry's rapid decline, which began after the tech heavy NASDAQ composite peaked on March 10th, 2000. The first factor was rising interest rate. The Federal Reserve raised the Fed fund rate several times over the course of the years 1999 and 2000. Higher interest rates tend to motivate investors to move money out of more speculative assets and into interest paying assets like bonds. The second factor was the onset of a recession in Japan on March of 2000. News of this recession spread fast and led to a wave of fear that triggered a worldwide sell off, moving even more money out of the speculative equities and into safer fixed income instruments like bonds. These two factors, among others, helped catalyze the bursting of the overinflated internet bubble. Internet stocks began to lose value, which spread fear among investors in turn causing additional selling. This self reinforcing process is known as capitulation, and the sell off continued until the Nasdaq hit the bottom around October of 2002. How long did the tech company boom last? How long was the bear market that followed? Bubbles, including dot-com bubble of the late 90s, don't really have a definite start dates, but assuming the bubble started sometime around 1995 and ended when the Nasdaq Composite peaked in March 2000, you can say the dot-com bubble grew for about 5 or 6 years before bursting. The bear market that followed lasted about 2 years. Which companies survived the dot com collapse? While many tech companies bit the dust during Bubble's collapse, some preserved through the turbulence and bounced back in the years that followed. According to New York Times, something like 48% of the companies involved in the asset bubble survived the crash, but most companies still temporarily lost the lion's share of their value. The following are an example of non-successful companies that survived the ill-fated tech boom. Number 1, Adobe. Number 2, Amazon. Number 3, ARM. Number 4, ASML. Number 5, Booking Holdings. Number 6, eBay. Number 7, IBM. Number 8, Intuit. Number 9, Oracle. Number 10, SanDisk. Now the information or the name of the companies that I have given was a past example, and their current value and structure is completely changed. So do not simply rely on the example, because these are the example based on the year 2000 crash, and right now some of them are the world's biggest company. After that, which companies went under during the dot-com crash? Many companies were not as lucky as those listed above. The following are a few former internet players that met their end when the tech bubble burst or soon after. Number 1, Boo.com. Number 2, Global Crossing. Number 3, North Point Communications. Number 4, Pets.com. Number 5, Webvan. Number 6, World.com. How did the dot-com crash affect the economy? Did it cause a recession? What defines a recession varies depending on who you ask, but it would certainly be safe to say that the bursting of the internet bubble led to a pretty severe bear market. According to most analysts, the dot-com crash did cause a mild recession, but its effects were not nearly as disastrous as those of the subsequent 2008 recession caused by the implosion of the mortgage-backed securities market and the housing bubble. Of course, many who worked in the tech sector become unemployed as the business they worked for saw their financing dry up. Adjacent industries like advertising were also affected as failing tech companies stopped pumping money into elaborate marketing efforts. Overall, it took the market about 2 years to get back into bull territory after the 2-year dot-com recession.